Hey, Market Chameleons. How's everyone doing this morning? Thanks for joining us again. Another pre-market morning show with myself and Dimitri Pargamonik. How are you doing this morning, Dave?
Morning. Pretty good. Thanks, Will. How about you?
Great.
Thank you, everyone, for joining us again. It's been pretty good. What is it, like not even 2 weeks yet? And I think that so far it's been pretty good. And I know just from receiving emails and comments and suggestions that I think so far so good with the pre-market reports.
Yeah, people are enjoying the show. If you do ever have any questions or want to see or hear something on the show, you can always put it in the chat, but also email us at support@MarketChameleon. We try to go through those emails every day and get back and go with those ideas. Also, we are streaming live on YouTube, so make sure you ask the questions in the chat. I will try to get them to Dimitri throughout the show. And make sure you like us and subscribe. That is a big deal for helping out Market Chameleon and making it a better show. With that, we should probably go to the disclaimer, right, D?
Yeah, I think let's do that first and get it out of the way. So you'll share that screen?
Yep, I'm coming up with the share of that screen.
All right, everybody, and while it's coming up, we're not professional investment advisors or broker dealers. I'm sorry, we're not registered investment advisors or broker dealers. We're not telling you what to do. We're just sharing ideas. If you need advice, then you should seek the advice of a registered investment advisor or call your broker. There's the disclaimer real quick.
Nice job, Dima.
All right, then let me just come back and share my screen again. Did that work?
That's perfect.
Okay, and what we'll do is, as usual, we'll just go over some of the pre-market movers. These are stocks, again, that are trading prior to the market open. In a pre-market, we have most active stocks, biggest percentage gainers and biggest percentage decliners. We'll go look at some earnings, and then we'll take some questions, and maybe I'll address some questions I've been getting through the emails. And really quickly, the first thing that in this pre-market report that popped out is this. It's a small cap stock, NTZ, that's up 100% in the pre-market hours on 4.7 million shares. We see that its market cap is low, 12.6 million, and it had some news here. This is some furnishing, fixtures, and appliances. Looks like it had some news here that it renewed its securitization facility. I don't even know. I'm not sure what that exactly means, but in any case, that seems to, it had a great reaction to that news. We see that right now the bulk of the VWAP is around 274, 290. We see that it's trading a little bit below here at that price right now. The range in a pre-market, keep that in mind, it's very illiquid. This is a small cap stock, so you could see traded as low as $1.20, as high as $3.15. Very liquid, but some people, they like to look at those small cap stocks. They get very good at trading illiquid stocks. So we just, since it popped up all the way at the top of the list, I thought it was just worth going in there and taking a look at it. Here's your minute-to-minute VWAPs, and you could see here, that it's trading a decent amount every minute, decent amount of volume, it looks like. And just real quick, let's look from a historical perspective what this stock tended to do after a big gap move to the upside. So we see here in the last 3 years, these are the biggest 12 gap moves at the open, and on average, they average 15.3%. We see as high as like 32%. So really, we haven't seen a gap move this high in the last 3 years at the open. And after the open, historically, it looks like it tended just to drift lower. So you see here, out of the 12 times, one after the open, it looks like, on average from the open to the high, it gained 2.5%. A lot of these times, what these zeros means is right at the open was the high of the day, and then it drifted lower. So you see only 42% of the time did it actually go higher from the opening price. From the opening to the low, on average, it decreased by 13.9%. From the open to the drift, it averaged a a negative 9.4% decline. Here coming out, it looks like, it's a mixed bag. Like 67% of the time it was down the next day, 33% it was up, but on the average, looks like it gained 1.5%. And I think it's this outlier right here. It had a 51% gain the day after. So this one, it's a new liquid stock. It looks like it kind of is all over the place, but since it popped up #1 on the list today and it had decent volume, I just thought maybe opening up and taking a look. Now, let's go to, I'm going to go to the higher cap stocks and see what's moving. So let's take a look at maybe over 100 billion. And one that popped up with the higher cap stocks is this TSM, Taiwan Semi. And I thought this was worth mentioning because somebody in the pre-market, when we were doing a pre-market report, one of the viewers actually, I think, mentioned this stock. I don't remember if he was bullish, but wanted to talk about it. So here it is from, since that time, it looks like today it's up 4.1% at the open on 184,000 shares trading hands. The bulk of it is trading between 69.94, 70.07.
Dima, did we lose you? Hey, everybody. Looks like we lost Dimitri for a second. He cut out. He'll be coming back soon. Listen, if you're in the chat, let me know things you want to talk about. Either you're seeing in the pre-market or you have a position in. If you're looking at a particular spread or something, we can get to that. Any other questions, let me know. All right. I'm seeing if you can reconnect. Let me.
Will?
Yep, he's back. There he is. Sorry, I was answering your text.
That was really weird. Just kind of lost connection. The computer self-rebooted. Let me
It happens, buddy.
Screen again. So here's that Taiwan Semi up 4.1% in a pre-market. We see that right now it's trading in a pre-market at a new 52-week high, closed its previous 52-week high, 69.25, which I guess there's some news there in the semiconductor industry right now. Intel just reported earnings, but let's just take a look at historically in the last 3 years, the last 12 biggest gap up moves. So we see here those averaged 4.7%, which is kind of like right, close to where it is right now. From that opening price, the average from the opening to the high, it's been 1.2%. The average from the open to the low, it averaged a negative 2% return. It looks like from the opening to the close, it's a mixed bag. About 58% of the time it was higher, 42% lower. And right here, it's just like a break even on that. And let me just see here. Yeah, I'm just looking at the median price. Just coming out of that, one thing just as an options trader, I look at like what are the moves coming out of that, absolute average moves up or down. So I see over here that the next day, on average, it moved 2.6% up or down. On a 2-day stretch, 3.8%, and so on. So this is kind of the movement it's experienced the next day following such a big gap. Let's take a look real quick also at Intel reported earnings. So that's down 14%. I think we looked at that straddle yesterday, and that straddle was basically not, I don't think it wasn't overestimating a move or underestimating a move compared to its historical actual average move. So it's like right in line. But we see today that, it made a huge move to the downside, down 14%. Let's see historically how that looked. So these are the last 12 earnings. This one is the most recent. These are how the stock behaved in the last 12 earnings 12 earnings reactions. So here on the opening gap, we see historically it opened up 64% of the time, down 36% of the time, for an average of 0.3%. Here, prior to today's, it looks like it's going to be opened down around 4%. Last one, it opened lower 4.8%, but looks like then to the end of the day, it actually gained it back. But after the opening, this is what this is how the ranges it tended to trade in. From the opening to the high, it averaged 2.6%. From the opening to the low, it averaged 1.7%. And then to the drift, it averaged a 0.9% gain. Coming out of earnings, it looks like a mixed bag. 64% of the time, day after earnings, it declined for an average loss of 0.7%. And these are coming out 2 days, 3 days, 1 week, and 2 weeks. That's how it tended to behave historically after earnings. Prior to earnings, we see it did that's when it did the best. It tended to increase. Of course, that's right now we have already announced the earnings. The next one, let's take a look at is Tesla. And that reported earnings yesterday. Looked like, right, so what did it do? So yesterday, right, it gapped up 5.4%, and then drifted lower 9.9% by the end of the day for, closed down 5% on the day. That's what historically it kind of, tended to drift down more than up. And then coming out, it's kind of a mixed bag, but it seems like, coming out 2 days, 3 days, it performed well. The 2 day, 3 day after effect. Last one, we see that the earnings before that, it also kind of mimicked that, right? It gapped up, then by the end of the day, it drifted lower to end lower on the day. This is what it did the next day, down 10.3%. So this is really quickly from a historical perspective, how that stock tended to behave. Now, let's turn to what's coming up next week, coming up earnings. And these are the earnings that are coming, haven't reported yet, are expected to report next week. Let's look at some of the major stocks, higher cap stocks, over 200 billion, trades over 5,000 contracts per day. So we see Pfizer's coming up July 28th. Right now, the straddle's implying a 5.5% move. We still have, a couple trading days to go up to that move, but that's 2.4% above its 4-quarter historical average move, and that's 3.1% above the 12-quarter absolute average move. And we see here it's moved as much as 5%, as little as 0.2% after the earnings has released. A couple more that are coming up: Visa, Facebook, PayPal, July 29th. That's MasterCard, July 30th. Procter & Gamble, July 30th. That's Comcast. Google's coming up July 30th after market close. Apple and Amazon are big ones, and then Disney. So these are some of the big cap stocks that are going to be reporting next week. This is how the implied moves are lining up today, but we still have a lot of days of trading prior to that moves that these straddles are pricing in as well. So as we get closer, we'll get a better idea of what the straddle is implying for that earnings move. Having said that, Will, you said that there were some, before that, you know what, I did have a question come up. And let me come to this screen real quick. And, we get a lot of questions, and I try to kind of answer them within the show sometimes. And this is a question that it came up, and I kind of see some questions repeating itself. So I thought it was just worth mentioning. One of the people who asked the question was asking, well, when you're looking at theoretical edge and you're looking at win rate, how accurate is it? That was the question. You know, a lot of people sometimes they'll say the delta, how accurate is it? Like how, and it's important to kind of understand pricing models and financial modeling, because when they say accurate, I think in their mind they're thinking like if it says 75% or 90%, that means that how accurate, if I do 10 of these, am I going to have 9 winners? And that's not exactly how it works, because what we're doing is using historical data to guide our decision making. And what I mean by that, to simplify, let's just say you had a basketball player, right? And like he shot from the 3 line, he shot 10 times and got 9 of them, right? 90%. Well, that's your data. That's accurate. 9 out of 10 times he made it, right? That's your guidance. So if he's going to shoot another 10, you use that data kind of as your guide. Does it mean he's going to get 9 out of 10 exactly? No, you know, probably not. He might be, but what you have is kind of a benchmark to say he does better than the average person, you know, or he's pretty good, you know, and then you give yourself, and that's how you start developing handicaps. Because remember, in statistical analysis, you just need to be right a little bit more than 50% of the time, as long as your average returns are positive. That's when and that's what you're trying to achieve to become successful. Of course, if you do credit put spreads, even if they're saying it's 90%, if you do all credit put spreads, 10 of them, right? Well, now you're long, you have exposure to the market, which means if that market goes down, you're probably going to lose on all of them, right? Because now you have market risk, right? You didn't, unless you hedged off that market risk, you're exposed to the market. And if you have 10 credit put spreads, even if historically they did really well over time, but the market, you have that exposure at the same time, the market goes down, you're going to lose on all 10 because that's your exposure to the market. So I think it's just important to kind of, and we have a lot of videos. I do a lot of videos explaining it. You know, you could kind of click on this, Edge Explain, that explains it as well. But that's the idea. We're using historical data to handicap and guide our decision making. Now, of course, other things to consider is what changed, right? Like, so if this basketball player shot 9 out of 10 times, you know, he shot 10 times and got sunk 9 of them. If he's up next and maybe he's sick, has the flu, injured his arm, well, now something's changed, and you got to take that into account, because the conditions that he was 90% don't exist today. So that's just really quickly, I thought it was worth mentioning, because that question kind of comes up like, you know, once in a while. But having said that, Will, if there are any questions, I'll take those.
Well, we have a Market Chameleon user who popped in, is super interested, but his question is really around, you know, and obviously there's always so much going on politically and on the global stage. He's asking why you and I aren't talking about what's going on in maybe China, or, you know, the embassies closing and how that will, you know, affect the market. And I'm trying to let him know in the chat, you know, that we look at the data, right? The numbers. And I mean, you have to take that into consideration, but like looking at the SPY, how does Dimitri take a look at the international stage, and how do you look at the vol? I mean, the vol is already elevated because of all these situations, right? It's the vol is showing us what is going on in the international stage, right?
Right. So the vol itself will probably, you know, reflect any type of known news out there. So right now we're like, you know, the implied volatility is in the 62th percentile rank. That this question actually just came up too. Like, what does that mean, 62 percentile rank? So what this is doing is looking at implied volatility in last year. So daily implied volatility observations. Where did the implied vol close on that 30-day constant maturity? And then it's comparing today's implied vol. So today's, like the last one was 20.9. And this is saying that 62% of the days, the implied volatility was lower in the last 252 days. Then this 20.9, 38% of it was higher. Why we use the implied vol percent rank? Other people use this implied volatility. I call it a position rank, where they take the low of the implied volatility in the year and then take the high and see where it's at. And they use that. And the problem with that is, like, let's say you had an implied volatility low of 20 and an implied volatility of high of 80, right? And then today's implied vol is like 30. Well, what happens is you think that the implied volatility is really low if you're just using those two data points. But if I told you that in the last 252 days, 251 of those days, the implied volatility was below 30, and you only had one observation that was 80, you might change your mind, right? Because then you think it's very low, but historically that was one time it happened, may not even occur again. So this is the implied IV percentile rank. It's showing you the percentage of observations that were below today's level. Why we don't discuss and we can, but realize, these are just, and everybody will have a different opinion and outlook based on this news. And when the news are coming out all the time, it could even change. So what we're trying to do here is kind of give guidance, like, here's the data and how you could actually use the data and apply the data to your outlook. Your outlook might be different than my outlook, but at least you could use that data, use the tools and analysis to help you strategize in the best way to get, the most desirable outcome that you can. So based on your outlook, what are the best available opportunities? And that's what we're trying to do, because I think at the end, that'll be much more valuable than if I just gave you my opinion on a stock here or there, because that could change as the information changes as well.
Yeah, well, and also the flow of the data into the marketplace is letting you know. I mean, the SPY vols, I mean, if we look at the vols, they are still very elevated. I mean, it is taken, all the market data during the trading day and analyze, and the volatilities are saying there is still risk. I mean, there is. So this is the implied volatility. We see, during that crash, went really way up here, came down right now where there's a lot of liquidity, a lot of money slushing around there. Here's the, this is the 250-day moving average of the historical vol. So it did dip a little bit below there. Obviously this came up because of that big crash. Again, we could put in a button, buy, sell, but that's not going to help you become a good trader. It's just maybe entertaining to hear other opinions, and hopefully the people in the chat, are giving opinions, because no, they are.
Yeah, and I think that what looking at diverse opinions helps you as well, because there's lots of information out there that people are reading that I might not even see. So I just kind of stick to the data and tools. Hopefully,
well, like if you were bearish SPY, he's asking right now.
Yeah.
Can we do a screener to screen? Like I prefer a credit spread, like a bearish credit spread. Can you walk through?
Bearish call spread? Okay.
Yeah.
So let's do that. We'll do like a bear call spread. So this one, just for people who don't know what this is just looking at a option strategy where you're selling one call, which is a bearish outlook, but to protect yourself, you're buying another call on a strike higher in case you're wrong and the stock really takes off. But let's just take a look in the next 30 days. Hold on, let me just move this because of my views being blocked by the little video. And so we're going to look at the next 30 days. We're going to scan. He just wanted SPY.
Yeah.
All right. I'm move this header. So this is, these are, I'm only looking right now in SPY, and what this did was look at the any expiration within the next 30 days. It's looking at different combinations of call spreads, and then it's running an analysis, a 4-year data analysis to see which ones mathematically look the best, right? So over here, what we want to do is maybe say, you know what, show me something that has a positive. I want to make sure I have a positive theoretical edge of 10%, and show me a spread that historically had a 70% win rate. So see, I'm just like narrowing it down here. And let's just say what we're looking for is, and depending on your outlook, but let's just say our outlook is the following, that we think that the stock is either going to drift lower or kind of just stay right where it's at. That's where we want, that's our sweet spot. If it just stays where it's at or drifts lower, right? Because you always have to have some kind of outlook. And for this, we're gonna screen for the best spread that has the best return on our risk if the stock is flat at expiration or lower. So here we go. This is what I'm going to screen for. Best return if stock is flat at expiration. So this is it. So in this spread, SPY, this is what it's telling us. August 14th expiration, if you buy the 332 call, sell the 328 call, $1.57, that's the credit you would receive, because remember, you're selling a call on one strike and buying a call on the higher strike, so you're receiving a credit. So that's $1.57 credit. We think the theoretical value is $1.12 based on the last 4 years of data. That's an 18% return. And we'll take a look at this analysis with a 72% historical win rate. Let's just see what this kind of means if the return is flat. So this is what we know, that this is a $4 put spread, right? 328, 332. At expiration, if the stock's above 332, if SPY is above that, 333, 335, whatever it is, you got to buy that put spread back for $4, right? That's it. It's a $4, I'm sorry, call spread. Call spread, you got to buy back for $4. If you buy back for $4 and you sold it for $1.57, that's your loss, $2.43. So that's your risk. $2.43 is the amount you have at risk. If the stock sits here at 322.83 or goes lower, or really as long as it's below 328 at expiration, then both these options expire worthless. They're both zero because they're out of the money, and you keep this credit of $1.57. So if you made $1.57 and you risk $2.43, your return is 64% based on the amount you have at risk. Does that make sense, hopefully, to everybody?
Yeah, it makes a lot of sense.
Okay. Now, what about this downside, this cushion over here? Well, here's another thing we know about this spread. What it showed it is that maybe we're wrong and SPY will go up, right? Like maybe it won't sit here, maybe it won't go down, but maybe it will drift higher. Well, here we know this, that the stock is 322.83. As long as even if it goes higher, as long as it stays below 328, we keep this whole, $1.57. If it goes up to 327, we keep it. 327.99, we keep it. So, just watch it. If it's at 328, then you got a pin risk. But if it goes above 328, since we received $1.57, we received $1.57 right here. So even if it goes above 328, it could go up to 329.57 before we break even, right? So we're losing above 328. We got $1.57, so it could rise by another $1.57 before we break even. That's the cushion we have. 2.1%. It goes against us it goes against us because we're bearish, where our outlook was bearish to neutral. It went up. We have a 2.1% cushion before we break even. So that's what these numbers are here. So let's just take a look at what's going on over here. like, why did we screen out this spread? And in this analysis, let me see, and some of you are used to it, maybe some, you know, we always have new, because I did a lot of videos on them, but let's just go over really quickly, and then I'll take another question. But so how do we get there, right? How do we get to these numbers over here? So this is what we know on the top. If on August 14th, we sell the 328, 332 call spread, we'll receive $1.57 credit. That's over here. The stock is 322.83 or 84. That's just repeating it. There's 16 days left, 16 trading days left to expiration. So not calendar days, but 16 actual days of trading. That we know. We also know this, that if the stock at expiration is below 328, right, or from today's price, if it increases by 1.6% or less, right? So as long as it doesn't increase by more than 1.6%, 1.6% or less, both these calls are worthless. So, you know, it stops at 327, 325, both these calls will be worthless, and this at expiration, this call spread is worth 0. We also know that if it goes above 332 or increases by 2.8% or more at expiration, that's 16 trading days. If it's above there, this call spread is going to be worth $4. Doesn't matter what you sold it for, you got to buy back at $4. We also know this, that if it lands anywhere in between 328, 332, or in this range, up 1.6% to up 2.8% from today's price, then we know at expiration is going to be anywhere between $0 to $4, depending where it lands. If it lands at 329, it's worth $1. Lands at 330, it's worth $2. So anywhere between 0 to 4, depending where it lands in between these. So having said that, what we don't know is the probability of these things happening, because if we knew with 100% certainty that, yeah, this stock's going to be above 332 at expiration, then we'll know, okay, in 16 trading days, this is going to be worth $4, right? If we knew that with 100%, it would be easy. If we knew with 100% certainty it's going to be below 328, we know it's worthless. But we don't know that. Really, there's no way of knowing that. So what we do, just like a actuary insurance company, we have to look at our historical data and see what did it tend to do? What did it tend to do during a 16-day stretch? And that's what this is. This is looking at 4 years of data, which you could change to 6 years, 10 years, or go to the options chain and change it to whatever you want. But it's looking at 4 years of data for a 16-day hold period. This SPY doesn't have earnings, but if it did, it would take it out. And it's looking at these 62 observations. And this is what it's saying. The data is down here. That the amount of times that SPY increased by 1.6% or less in that 16 days, that happened 56% of the time in our observations. So 56% of the time, historically, this would end up being 0. The amount of times SPY blew through 2.8% in the last 4 years after 16-day hold, that happened 24% of the time. So 24% of the time, almost a quarter, this spread would be worth $4. The amount of times it landed in between, that happened 19% of the time for an average of $1.51 price. The data is all down here. So if you take 56% times 0 plus 19% times $1.51 plus 24% times $4, add them all up, that equals to $1.26, right? So this is actually from yesterday's, because this is looking at the most recent. So in other words, if you did this trade over and over and over and over again, historically, that's your average price. So this recalculated to the most recent. This is as of yesterday's close. So it just took in that's why it's changing a little bit. But that basically saying that if you did this trade over and over and over again, that's your average price. So if you sold it for $1.57, bought it back on average for $1.12, and you're risking $2.43, that's your average return on your investment. 18.4, 72.6% of the time. That's the amount of times this would have resulted in a profit.
Awesome job, Dima. We
Okay.
are 2 minutes away from the bell going off, buddy.
Hopefully
you carried
that
us
was
through for
helpful.
50 minutes. That was incredible.
Okay. So we got to analyze a trade today.
Yeah, that was a big job. Listen, I put a
Okay.
link for everyone to the SPY poll we're running for next Friday's close in SPY. Will it be higher or lower? You can go to the poll question on our community page. The link is there. Also on Monday, we will be having a webinar with Felix Frey. I think, D, it's really going to be focused for beginners, early traders, correct?
Yeah, I talked to Felix and we were discussing what we should do. And I think that right now, because we haven't had that many for beginners, I was talking to Felix, he's like, why don't we do one for just very beginners getting into options? So that's what we're going to do on Monday. It'll be a little bit different, but the focus will be for really the very beginner traders.
Awesome. With that, happy Friday. Have a good trading day. We will see you on Monday's show, correcty?
Yeah. See you guys on Monday. Have a good weekend, everybody, and thanks for joining us.
All right. Have a great trading day, everyone. Stay safe.
Thanks, Arian.